All right. Every year I make predictions. It's been difficult this past couple years because we got hit with the ultimate black swan event called COVID. Last year, I said predicting and forecasting GDP would be futile, but it would have a high degree of volatility quarter to quarter, and GDP growth would be positive for the year 2021, depending on the size, structure of the monetary and fiscal stimulus. Well, GDP was positive. It was actually better than I would have expected. Came in at 6.3% in Q1, 6.7% in Q2, slowed down a lot in Q3 to only 2%. Now, part of that is probably because of the Delta spike, but there's other factors that played into it as well. Why did GDP do better? Because, man, we shoved a lot of money into the system, both from a federal spending standpoint as well as from a monetary standpoint. The Federal Reserve, after injecting $3 trillion into the capital markets, injected a whole nother $1 trillion this past year. Second prediction, I said after experiencing a partial V-shaped recovery in 2020, where it would go from here would depend on who won the presidential election and the policies he or she enacted. Well, President Biden won. He aligned himself with the progressive wings. They immediately spent another $1.9 trillion after we had just done another big package, I'll get into that later, and has continued to push for additional fiscal stimulus through an infrastructure plan and Build Back Better Act. I said predicting unemployment would continue to decline, albeit at a slower pace, but it would remain high as larger corporations instituted layoffs aimed at white-collar jobs. Blue-collar and lower-income employment numbers would continue to improve. Well, there wasn't a lot of layoffs with white-collar, so I was wrong on that. Blue-collar labor boomed back as restaurants started opening back up, hotels, recreational facilities, the whole travel and leisure and retail started reopening. So unemployment has fallen to 4.8%. I'll get into that. Significantly down, but still above pre-COVID levels. Okay, on rates in the equity markets, predicted that the 10-year Treasury would have volatility between 0.6 and a 1.2 yield, with short-term rates anchored at 0. If the massive stimulus bill passed and inflation spiked, the 10-year could rise to 2%. That's pretty good on it. Short rates stayed anchored at 0. The Fed was very clear on that, so it was an easy prediction to make. The 10-year Treasury fluctuated between 1% and 1.75%, and then reversed, or peaked out at 1.75 and then reversed back down to 1.2 in August and is now at 1.61. Who knows what it is this morning, but that's where it was yesterday. Equity markets would incorporate too many variables to predict the direction of valuations, but predicted that volatility would remain high. You know what? There wasn't much volatility. It was a one-way grind straight up because the Fed kept injecting liquidity and the federal government kept spending money. The equity markets just kept rising. Predicted certain goods and services may show some deflation, but the Federal Reserve's massive expansion of the money supply, asset prices, and commodity prices would inflate. We'll be getting into that very shortly, and that's exactly what happened. Real estate values would depend on the demand and cost of availability of financing. Well, rates have remained 0. Long rates have been exceptionally low. And banks have been more than willing to lend on real estate. So real estate values have continued to lift. And lastly, demographic shifts out of high-cost, high-tax states would only accelerate. We have had the biggest demographic moves that we've ever seen in our country in such a compressed period of time. For those clients of ours in Utah or Boise or Arizona, you know what has unfolded. People have been flooding into those markets, and a lot of them coming from this state of California.